Welcome to this home buyers seminar. We are calling it Home Buying 101 because it's going to be an interactive session. My name is Floyce Majeski. I'm a real estate agent with Broker Nation Real Estate under the Nino Group. So I will now invite Jennifer to introduce herself, and then we'll take it from there.
Thank you. Good morning, everybody. Thank you so much for joining. My name is Jennifer Kurz. I am a mortgage loan officer with Round Point Mortgage, a subsidiary of Freedom Mortgage. And I have about 10 years of experience in the industry, both as a realtor and as a mortgage loan officer. Realtor in the past, no longer the case, but I'm excited to be here, to be able to help you guys in right next to Floyce and answer any of questions you guys might have and give you perspective.
So we are going to our presentation now. When you call me or any real estate agent and ask about buying a home, we will talk to you for a couple of minutes and then we'll ask you if you are pre-approved, if you've talked to a lender. It is not just based on what the real estate agent will talk. We cannot take you on a home search tour before we know that you are ready and you're qualified. So this is where Jennifer comes in. We don't want to get you excited and get you emotionally attached to a home that you really like and you cannot afford it. So that's why we send you over to a lender. So Jennifer, what can you add to that?
So, consumers are now becoming a little bit more aware. Way back when I started, and even before that, a lot of consumers would want to go see houses first, and they'll fall in love with this house, and then they don't realize that they're not yet ready to submit an offer, or they don't realize what the monthly payments are going to be, or if even if they had the capacity to make this purchase. So, with all these mistakes that took place, a lot of consumers right now, just like you guys are, you're here to figure out what it is that you need to do to get prepared. One of the biggest things to do in order to get prepared is get pre-qualified before you get on the road. And equally, sellers are looking at pre-qualifications before even considering, or actually a pre-approval before even considering your offer. So these are very important. This is a very important step.
Okay. Now that you've heard about that term pre-qualification, let's go to the next slide and see what that's all about. So Jennifer, again, I'm going to throw it back to you. I want you to take us through that phone call. Somebody calls you and say, hey, I just talked to my real estate agent and she or he said that I should talk to a lender and get pre-qualified. What does that mean? So take us through the steps, please.
Okay, so a lot of people think, pre-qualification or pre-approval are similar. Pre-qualification, at first, our conversations are going to be, so you'll have a conversation with a realtor. They'll semi-pre-qualify you and ask you a couple questions to gauge your readiness. And then they'll put you in line with a lender that they might trust, or they'll ask you to contact a lender you trust. And when you do that, our questions are going to be specific to your current income and employment, your assets, your credit, your history of employment, and all of your liabilities. But these questions are just so that we know how we're going to help you throughout the process. Now, just letting us know this information verbally is not enough for us to actually give you a pre-approval. So essentially, it's going to boil down to, okay, now I need to verify your income documents and your assets and all those things. So it's going to be based on what you guys provide to us in that initial conversation. So just as a quick thing to keep in mind, these things are important. We look at all of it, and based on your income and your available funds and your credit and all those things is how we can boil it down to what you guys qualified for. So you may have money, but that doesn't necessarily mean that your income is reflected correctly, or your credit and stuff like that. So I guess in this particular slide. We just want you to know that these are important and you need to be aware of that.
Okay, just real quick, Jennifer, you mentioned assets. Can you at least give us 2 or 3? Some people don't know what they are, if it's actually assets. And also you mentioned liabilities. So just those 2, can you quickly elaborate?
Sure. So assets will be basically the amount of money that you have available. So we cannot give you a pre-qualification based on you having a vehicle with some sort of equity, right? So we don't do that type of trade-in. You would have to sell that vehicle, have those funds, and we'll have to prove where those funds came from, right? But basically, these are funds that are in your account, whether it is retirement accounts, savings, and I guess another part to ask is a lot of people think that just plain old cash is it's okay to use for your purchase, but it's not. We cannot use funds that cannot be sourceable. So, you have to keep that in mind. Funds that you put away for your purchase, make sure you put them in your savings and that you have a reason for why you're making these large deposits. Where did they come from? And then in aspects of liabilities, so when we, a lot of people will ask, why do I have to run my credit right now? So there are multiple factors why credit is important. One is the score. There's minimum score requirements with Fannie Mae and Freddie Mac guidelines. But those requirements, with the credit, we determine your liabilities. What debts do you have? And how do these debts affect you? And, there are certain guidelines that we have to follow as well. So if you have disputes or if you have collections, we have to take a look at those. And even though those are collections, you're not paying for them, we actually have to account for a certain percentage of that liability against your income, which could potentially reduce your qualification. What I would say is don't get ahead of the game and try to figure these things out on your own. Let somebody guide you through and determine whether or not those liabilities will affect your ability to qualify. But liabilities definitely are important because you have to stay within a certain debt to income ratio.
Okay. Yeah, because most people don't really think about that. You have to, like she said, you have to think about, how much debt you have before getting another debt.
Yes, but don't look at the whole balance. What we're looking at is the monthly payment, because the monthly payment is truly what affects your monthly debt to income ratio.
Okay.
In our review.
All right, great. And like I said, if you have any questions, please put them in the chat. We're gonna look at them shortly. So the next slide is what everyone, I'm guessing, is here for. The options. What options do I have? I know you're gonna pre-qualify me. Maybe I might get it, I might not, but what are my options? So Jen, again, take us through the options.
So we had originally discussed cash as a form to be able to purchase a property. So cash in aspects of obtaining a loan, we have to verify where those funds are coming from. And then we would need, basically there are certain down payment requirements. So that's where your cash will come from. If you purchase plain cash, then, you got to look at the same thing, where are these funds coming from? But there's nobody that's really going to verify these things specifically. It's more on your end and how you're going to be taxed for this and stuff like that in the future. If you're like a foreign national using cash, where did it come from? Those kind of things. So the loans that we usually use that everybody sees are conventional, FHA, and VA loans. VA loans, just to knock this out real quick, these are for veterans, people who served in the military and have been honorably discharged or are still serving and basically qualify for this loan. And this one is a 0 down payment loan, no mortgage insurance. And the minimum credit score for VA loan is, we can go as low as 550, but ideally 580 and above. there are more requirements at 550. So somebody asked, what's the minimum credit score required? It varies on the loans. FHA and BA are very similar in aspect of credit score requirements. So same thing, 550 or 580 and above. At 550, you'd actually be putting a higher down payment. So you'd be putting 10% down. And of course, we would have to see why you're at 550 and look at that in detail and make sure that that goes through. And then, but 580 and above should work just fine. And then in conventional loans, they're a little bit more strict. Conventional loans do require a minimum credit score of about 650 is ideal to have. Once you're in the 640 range, more down payment is usually required. But with conventional loans, you'll have mortgage insurance if you put in a down payment that's less than 20% down. Once you reach 20% equity in your home, then that mortgage insurance can be removed. Okay, and that mortgage insurance gets added to your monthly payment until it gets removed. And then eventually it gets removed on its own with a certain period of time. In FHA loans are more flexible. As I had mentioned before, the credit score requirements are flexible. The down payment on an FHA loan is 3.5%. And this one has mortgage insurance throughout the entirety of the loan. Biggest reason for mortgage insurance is to protect the lender. You know, you're coming in, if you qualify for an FHA loan and not a conventional loan, a lot of times it's either your credit score is a little lower or you don't have enough funds to be able to put as a down payment, you know, so you'll have, you know, the interest rate might be lower, that'll help you qualify as well, but essentially it's a bit of a riskier loan to a lender, and therefore they put the mortgage insurance. Same thing with conventional loans. Conventional loans, you can come in with as little as 3% down, but you know, as a first-time buyer, if you qualify, and the mortgage insurance serves the same purpose. You know, you're coming in with a lower down payment. You know, so you know, the way that they protect themselves is by having the mortgage insurance up until there's 20% equity on your home. And I mean, I think that's pretty much it on those programs. If you're multiple buyer on conventional loan, it would be a minimum of 5%.
Okay. Just real quick, Jen, about VA loans. These are not loans for everybody, right?
No.
Yeah.
No. VA loans are specific to veterans that qualify and have full entitlement available. And that veteran cannot purchase a home with anybody other than a spouse or another veteran. So the government programs mentioned on there, I know somebody asked that question. The government programs are basically just programs that'll help with down payment, like down payment assistance programs. And those will require a credit score of about 640. And then also they're very specific with the debt to income ratios as well. But you know, these are programs for people who have less assets, less funds available to be able to purchase. And basically you would just have to qualify first with the county, and then you know, and then be able to submit an offer. The seller has to accept that you're using these funds as well. But that's what those programs are. Okay. For down payment assistance.
Before we go to the next slide, I have one more question because somebody asked me this. They were looking at an area that they wanted to buy, and she said she was afraid because that area seemed to have more taxes, property taxes. But I wanted you to, because I know and you know that the property taxes are not, in most cases, they are included in your, if you're financing, they're going to be included in your monthly. So it's not something that you pay out of pocket. Let's say your property taxes are $5,000. You're not going to pay like $5,000, a large sum amount at the end of the year. If you're financing, you're going to be paying, it's going to be broken down into your monthly payment, right?
Correct. So the way we calculate it is we figure out what the taxes are for the year. and then we divide that by 12 months. It's as simple as that. And then basically you're paying, 1 out of 12 of the total amount every single month. And then what happens is when the taxes are due, these funds that you've been paying every single month, they go into an account. It's called an escrow account that the lender holds. And when the taxes are due, the lender then pays the taxes for you. And then it just continues. It's a cycle. If the taxes change and vary and you have less funds available in your escrow account, it is highly possible that you'll see an increase in your monthly payment just to cover the expense of the new taxes and stuff like that. The increase is usually not very much, though.
Okay, I guess we are ready for the next slide. Things to do. What do we need to do? All right. Go ahead, Jen.
So one big thing is savings. Yes, there are down payment assistance programs out there. Our market is a bit aggressive right now. So I've seen a lot of things happen. There are people putting funds above appraised value in order to compete with however many people are on the market right now. And so one big thing I tell people is it's important that you are financially prepared and that you have funds available, whether it is to negotiate or make any repairs or anything specific to your home. You want to make sure you have the funds available to complete your purchase and be ready after that. Deciding how much home you can afford. So many people qualify for more. And they don't really want to use that loan amount, because it exceeds how much they're comfortable paying on a monthly payment. So just being aware of what your comfort zone is and what your threshold is, like where you certainly cannot pass is important. And as lenders, even though we'll qualify you for a certain amount, we, a lot of times we can try to figure out ways to guide you to either being able to qualify for more by paying down certain type of debts, or maybe seeking better employment with higher income, or or if you qualify for more, then we'll just adjust the price point based on your qualification, based on your needs, and yeah, so definitely monthly payment is important. What you can afford, what you feel comfortable with. Last thing you need is a foreclosure or a short sale in your credit. Credit is obviously very important. We've discussed this multiple times throughout this presentation, and so it's important. Oh, sorry, I was getting a phone call. It's important that you continue to make payments on time on all your credit cards and loans that you have. If you don't have any credit, start obtaining credit, apply for credit cards, see if a family member with a good credit history on a credit card is able to add you to that account. That'll help give you some history. Get those cash advance cards. I think it's you pay a certain amount and you use, and basically they give you that as credit, and then you use it and pay it back and so forth, and that gives you some sort of history. I believe that the bureaus also have like credit boosts. So, go to each bureau and see what kind of credit boost systems they have, and they'll gather your ability to make monthly payments on time for your phone bill and utility bills and stuff like that. And that helps boost your credit as well. So, really, really focus on the credit. Credit is so important. I joke around. I said the government wants you to be in debt. People that don't have credit or don't have debt don't have an ability to report an actual on-time monthly payment, or their ability to have a certain amount of limit and use it and pay it down. So it's important that you assume some of this and generate your increase your credit and strengthen it. Explore the different mortgage options. You might be able to qualify for conventional and decide that you want to do FHA instead because the interest rates is lower and your monthly payment might be lower. That is a possibility. You might want to refinance later when you have enough equity. and then remove the mortgage insurance. Those are possibilities as well. Or if you qualify only for FHA, how can you qualify for conventional? That's an option that you would rather have, so definitely understand these options. And there's, and in the future, we'll dive in a little deeper on each program and the requirements so that you have better understanding, and make an educated decision. The first time home buyer assistance programs, those are all the down payment assistance programs. So I think somebody was asking about that on the chat, first time buyer programs. So FHA is a first time buyer program. It gives you the ability to come in with 3.5% down. That's a very low down payment. The interest rates are very low. Yes, it has mortgage insurance, but it protects your loan, and conventional, if you're a first time buyer, conventional, you can come in with at least 3% down. It's even less than FHA. Okay. So that's pretty much, those are it, guys. A lot of people think that there's so much more. Pretty much is that the first time buyer programs, a lot of you come in with a lower down payment, and some are a little bit more flexible with credit. And then you have the ones that I had mentioned previously, which are government assistance programs that help you with down payment assistance. And they all vary. The counties have different ones. You would have to check in with your counties and see what is available. There's other ones that are like grants, but you have to stay in the property for a certain amount of times, usually 10 years. If you sell prior to the timeline that they provide, then you have to pay them back. It's certain little things like that, and these down payment assistance programs, they'll help you purchase, but some of them are actually a loan that they tie into the back of your loan, so, and again, we can go through these in more detail in another presentation because they are a bit lengthy, but they are available. I would say go to your county website and research on that. Compare mortgage rates. So every lender has different rate options, based on their company's financials and stuff like that. There's a base that the government throws out, but there's a certain, every lender has different rate options, but we're all very competitive with each other. Rate is important because it affects your monthly payment. But, I would say sometimes you'll find the lowest rates with a lender that doesn't have many expenses, but then you'll have a very difficult process in getting the loan. So it's also important that not only does the rate work with you or for you, but that you have somebody that is there throughout the entire way to help you and guide you through your loan process and doesn't drop the ball and essentially affect you in your purchase. Get a pre-approval letter. That basically boils down to having that conversation with the lender, providing the lender with all the documentation that they need, all of the documentation that they need. The more you provide, the better they can give you a more solid pre-approval letter based on your specifics. Okay, every person's different. Every person's financial situation is different, and employment situation is different. The way they obtain their funds is different. So, I always tell my clients to be honest and transparent with me so that I know how to guide them best. So I would suggest you do the same. You do that with your lender, and then and choose a real estate agent carefully. So the realtor, I used to call the realtor the rainmaker. Okay, the realtor has all the relationships. The realtor is the person that is going to it's going to show you the homes that you like after you get pre-approved and negotiate on your behalf and make sure to protect your interests as you move forward in your purchase, and listen to them. Choose a realtor that is there, that cares, that's available, that shows you the information that even if they don't know the information at the moment, that they're willing to gather whatever is needed in order for you to be able to make an educated decision on your purchase. And also listen to them. They are in the industry every single day. Your cousin and your neighbor and everybody else around you has had a different experience, and again, different finances and different scenarios. So you can't go based on their experience, and they lie. A lot of them lie. They have no idea what is going on the back because it's a lot, it's a lot of information. So choose a realtor that you trust and stick to them.
Okay. Before we go to the next slide, Jen, I want you to talk a little bit about the market condition.
So currently what I'm seeing in the market is there's strength in the employment that people have. You know, there's a lot of people that are making a lot of money right now. You know, they're working very hard. There's self-employed people that have found this virtual world to be very effective for them because they have lower expenses, you know. So you know, there's people out there that are making money, that have employment. There's jobs available. You know, the interest rates are low. So in a market where the interest rates are low, there's going to be a lot of demand for loans. And because there's so much demand, the inventory is also low and limited, you know. And when there's a very low inventory and high demand, what you're going to find is an increase in price. So a lot of sellers are asking for more, and this could be a bit tricky because now people are buying into properties with, you know, and putting in more money into the property than it's actually worth in order to compete. And I would say the only reason why that makes sense is because their monthly payments are actually lower in that mortgage.
Mm-hmm.
And the loan is still based on appraised value. So whatever balance they have on their loan later on in the future is based on current appraised value, what's selling in the neighborhood. But under the same breath, I will say that the closed sales are reflected, are you know, include that above appraised value purchase. Therefore, the prices are being driven based on these sales. You know, even though these people are purchasing and the loan is based on appraised value on whatever is selling in the neighborhood, it's also driving the price so much, so high that even at a low interest rate, some homes are becoming unaffordable, you know, in certain neighborhoods. So, you know, I would say be careful out there, but be strong. If you really want the property and you can afford it, make sure it's something that you can afford, you know, and don't get discouraged. And, you know, the market will adjust. As soon as interest rates start going up a little bit, the market will adjust. And what we'll see then at that point is some values will reduce, you know. So it'll be a positive thing for buyers, but it might be a negative thing for sellers at that point. A negative in comparison to now, obviously, because we're in a bit of a crazy market.
Okay. I see there's a couple of questions in the chat, so we are coming to the end of this so that we can address those questions. The last slide is about the people that you will need to know along the way as a home buyer. You know, you're gonna need to know a real estate agent, like Jennifer said. You gotta find someone that is working for you, working with you, and knows about the different products that are there and knows the right people to, you know, point you to. Then the lender, we have one, of course, today. A very helpful lady, I'll tell you that. And then we have the title company, and you will need to also know a real estate attorney. We're not gonna get into this. I'm just mentioning this so that you guys are aware that these are people that you're gonna hear mentioned here and there during your home buying process. So now we will take the questions in the chat. I'm gonna stop sharing. We wanna thank you so much for joining us today. We appreciate you for taking the time and for you know, registering. We hope to see you again because this is just the first step. So we have a couple more steps down the road, and I would request that you register for the next one. I'll share the details to everyone that registered for this one so that you know where to go to do that, because we will be having them on Zoom only. They're not going to be live on Facebook. So do that. So Jen, I will let you say your closing remarks in a bit, but I want us to see. Let me stop sharing my screen so that we see who is in the chat and what they're asking. Somebody asked, what is the minimum credit score to buy a home, or does it depend on the loan? I think.
So yeah, it depends on the loan, but I would say that listen, you qualify for a loan, you qualify for a loan. It doesn't matter. You're going to purchase a property. The programs are just relevant mostly to the buyer in their ability to qualify and what the loan program requires. So FHA is one of the programs that allow a much lower credit score. Therefore, you have mortgage insurance throughout the entirety of the loan, but you'll qualify for a mortgage. So it's in my opinion, in the seller's perspective, usually, why does it matter what loan program does the buyer have, to purchase? You're going to get the same amount of money. They qualify for the program, right? So with FHA, that's I would say if your credit score is above 580, it's highly possible that you can qualify. We would obviously have to look at income and assets and make sure all those things are squared away, but yeah.
Okay. Then we have Diana. She said, what's the government program? I think she wanted to know more about that slide that we had, the government programs as options to buy. We're gonna compile a list, Jen and I, and send it to you so that you look at some of those programs. And like Jen said, you can also talk to the city and see what's available out there. Jennifer, you can add to that as well.
Yeah, I mean, government, there's government assistance programs, and then there's just the government loans. Government loans are Fannie Mae or the FHA and the VA loans. Those are government loans, and so concept of government, that's what it is. It's federal government, sets up the guidelines for us to be able to give you guys a loan. But those assistance programs are the separate things, and those, some of them are county based, some of them are state based, and we'll gather a list of details for that to provide to you guys so that you can be prepared if that's what you need. Yeah, we can go from there.
Okay. There's another question. Does everyone that is buying for the first time get qualified for the first time home buyers benefit? So if you're buying for the first time, do you get the first time home buyer benefits?
So if you're buying for the first time, then you are able to qualify for the first time buyer benefit of the lower down payment requirement and credit scores for FHA and conventional. Mm-hmm. But there are other requirements, so conventional is a little bit more strict with credit score. So yeah, you'll have to have a higher credit score. But if you're a first time buyer, you can do the 3% down with a conventional loan. With FHA, you couldn't have had another FHA loan within the last 3 years. So yeah, so there are certain things that we would have to consider, but so if you're a first time buyer, you should be able to qualify for all these programs, I guess, to answer your question.
Okay, then
it just depends on your, there are other factors, but yes.
Okay, then we have Diana. She asks, cities have first time home buying programs. Is that the same as government programs?
Assistance programs, yeah.
So that's the same.
The down payment assistance program. Yeah.
Okay, cool. So I think, like I just said, I will let Jennifer give the closing remarks, and then I think that's it for today. Does anyone have any other questions? Do we need to take a bubble one? If you feel like you need to admit yourself and say something, and now is the time, feel free to do that. Otherwise, I'll let Jennifer close us out, and then
there was a question that just came up.
Sorry.
The question was, would you recommend taking from your 401k as down payment, or can you use it as your assets? So yes to both. So if that's where your funds are and you want and you need funds from your 401k, just find out with the company that holds your 401k and what the terms are in removing those funds. Some of them you have to pay back. monthly. They do like a little loan against your funds, and some of them you don't. So it truly depends on those terms. But if that's where your funds are, you can certainly use those for your purchase. If your purchase is really important and you have to do that right now and you want to take from there. And in concept of assets, I think it works hand in hand with available funds for purchase. So if that's what you're using it for, yes. If you need reserves, so basically if you're buying a multifamily property, and we're using rental income from the other units in order to help you qualify, then you're going to need reserves. You're going to need 6 months reserves. So we can account for the funds in your 401k as reserves. You don't have to take them out. We can just account for them. So that's another form of asset that we can use.
Okay, and I know this is off topic, but I wanted to also mention this because someone asked me, well, I want to buy a home, but I want to buy one and buy another as an income property. I know we're not going to tackle that today. That's too much. But I think, Jennifer, you can maybe slightly say something about that, about buying income properties, and maybe a little bit about the financing.
Sure. So if you're buying a multifamily that is going to be your primary residence, then that's pretty much an income property that's going to help you, and you can use an FHA loan with no problem, 3.5% down. Same concept of credit scores, the same thing. You would actually qualify for more. There's limitations on the loan amounts, depending on how many units. The more units there are, you can go up to 4 units. You can qualify for nearly $1 million here in the state of Florida. For a multifamily. So that's one income producing. But if you're buying a personal or, primary residence, and you decide that you're going to buy another property, then that would be a conventional loan because it's an investment property. And in that case, you would definitely need about 20% down because it's an investment property. And you will need reserves of similar amount, about 6 months, to show that you have at least 6 months available to be able to make the payment on the new investment property, in the event of default, you don't have a tenant. But we also use tenant income to help you qualify for that as well.
Good. So you guys, you got to start thinking about that. Don't just think about getting your own home, maybe just as a resident, as a homestead. You got to start thinking about also maybe getting an income property, a rental property that you can rent out, and then that income will help pay for your mortgage and stuff. So Jennifer, I want you to close us, and then I will unmute everyone and you can say your goodbyes, and then we'll see you next time. Jennifer, close us.
All right, awesome. Well, I want to thank all of you guys for joining us today. And Kurz, keep moving. There are some good realtors out there that'll actually show your offer for what it is and for who you are and your reasons, and I've already seen that happen multiple times. So don't get discouraged. Just keep moving, and definitely get pre-qualified before you get out on the streets, because you don't want to waste your time, your emotional your emotional self, and then you also don't want to waste other people's time. But yeah, we're here. Anything you need, reach out to us. We'll provide you with our contact information. But since I'm here now, my phone number is 305-401-2778. So feel free to reach me there anytime if you have more questions.
Okay, thank you so much, Jennifer, for coming today. And like I said, this is a partnership. We're going to be doing this more often. So if you have a friend that needs to hear this, what you had today, please have them register for the next one. My number is 754-215-1911. I really want to appreciate you for coming, for registering, for taking the time to listen in. We are looking forward to working with you and hopefully to get you into a new home. Thank you so much. Have a wonderful day.